It's a pleasure and an honor to be here. Welcome to all of you to what I hope is turning out to be a delightful conference for you as much as it is for me. The title here, Thinking Historically, is meant to convey a methodological orientation toward understanding banking crises. And I want to emphasize that this is not coaxing you to do to study history because I think you should find history interesting per se, although I do. But what it really is more of an attack. You might even call it a full frontal assault on any attempt to understand banking crises that doesn't learn to think historically, not just be knowledgeable about historical facts, but to think historically. And so that's going to be my theme, and that's going to be, you might say, my whole line of attack. So I'm going to, over the course of this lecture, define specifically what I mean by thinking historically. But I want to start with the most obvious thing that it means to think historically, and that is to be aware of basic facts when formulating theories. So I want to point out two basic facts that turn out to be extremely troublesome for theories of banking crises. Fact number one, the constancy of bank contracting structure. So roughly speaking, since the 6th century BC to the present, with some important modifications of the particulars, the contracting structure of banks has been constant, and it pretty much looks like this. Banks fund opaque loans with very low risk, short-term debt to which they attach a first-come, first-served rule. In other words, they give an obligation that says if you're a depositor, come get your money back, and you get your money back and walk away. If there's not enough for the person last in line, tough for that person. So that orientation, by the way, that's not the way we structure debts in other companies, but we've done this for banks for a very long time. When theorists look at this, including work I did back in the early 1990s, they tend to argue that this is an equilibrium, this is an efficient contracting structure, because it creates discipline on the banker, precisely because the banker is in this control situation with these opaque assets. And then further notes that once you've created this credible discipline that conveys a lot of information, that is, if you know that the bank is open, you know that relatively informed depositors have chosen not to run the bank, which means that you are able to share a lot of information about the value of those claims, meaning that they're very good claims. And that makes them liquid. That explains how demandable debt subject to a first-come, first-serve option not only disciplines bankers in their risk management, but it also creates a liquid claim that we can trade. So this is a pretty understandable contracting structure. Theoretically, we believe that these functions I just described are very beneficial, discipline and liquidity, and that therefore we can understand why this contracting structure emerged in Athens in the 6th century BC and has pretty much been the story ever since. However, there's a second fact, and that is that banking crises have varied hugely across time and space. When I say banking crisis, I mean one of two things. That is either one of two things. Either a crisis in which a lot of banks in the system experience sudden withdrawals of deposits, even though it turns out that they are not facing a lot of bank failures. So there have been banking crises where there have been lots of sudden withdrawals of deposits without failures. Or a banking crisis where there's withdrawals of deposits and lots of failures. So whether it's that's my definition. That's also the Levin Valencia IMF definition of what a banking crisis is. So when I say that banking crises have been very different in their frequency and severity across time, I'm referring to that set of phenomena. So when we look at world history, we see that banking crises vary hugely across time and space, despite the fact that contracting structures don't. Now, just to give you an idea, from 1874 to 1913, worldwide, by my definition, there were only 10 banking crises. And 5 of those, by the way, were U.S. panics where there were virtually no bank failure losses, no negative net worth of failed banks relative to GDP to speak of. Of the other 5, they were solvency crises in 5 different countries outside the U.S. 4 of them, by the way, were real estate-related banking crises. We'll come back to this point. It's a recurring point that we'll see. But when you total those 10 crises together, the severity measured in terms of the negative net worth of failed banks as a fraction of GDP was about 3% on average. So we had 10 banking crises worldwide over this 40-year period with about a 3% severity measure. Now, from about 1980 to 2013, similar period, we had over 100 major banking crises by this same definition, with an average severity of 16% negative net worth to GDP. So crises have become 10 times as severe relative to this earlier period. 10 times as frequent and 5 times as severe. Furthermore, we observe in some countries that they've never had a crisis. For example, Canada. Canadian banks began to be chartered in 1817. We've never had a Canadian banking crisis. Now, I want to emphasize, despite the fact that Canada is a highly volatile economy, a primary commodity exporting economy, more volatile as GDP than the U.S. So it's not that there isn't instability economically in Canada. There's plenty of it. Furthermore, Canada, if you thought, well, maybe Canadians just don't have much banking going on. No. They've had equal to the U.S. or in excess of what the U.S. has had in terms of bank credit relative to GDP throughout their history. The U.S. has had 17 major banking crises. Canada's had 0. Why am I focusing on these 2 facts? The constancy of contracting structure, the ubiquity of contracting structure, and the differences in the incidence of crises? Well, obviously it's because that points out that contracting structure cannot be the main or only story about banking crises. And in other words, just these 2 facts juxtaposed pose an enormous problem for ahistorical theories of banking crises that focus on contracting structure stories by themselves. And by the way, that is pretty much the entirety of the theory literature on banking crises. Let's go through that a little bit. By the way, I'm not saying these theories are wrong or useless. Quite the contrary, as I'll show you. They're very useful, and I don't think they're wrong. I'm simply arguing that they're incomplete. So the basic theory is that crises happen when there's a big aggregate shock. It affects banks because banks are issuing lots of debt. They're highly levered. It also may affect them even more because of the opacity of the bank's loan assets. That means even if you're a solvent bank, even if you're unaffected by the crisis in terms of losses in your loans, it's hard for people to know that. And so big observable shocks can lead to also problems of withdrawal from banks, even from banks that are only experiencing slight increases in their insolvency risk, or maybe not even any in their true insolvency risk, which causes banks to have to meet those withdrawals by cutting back on their loans, converting to cash, and that's called disintermediation. You might call it risk management, to preserve their access to the deposit market in a disciplined setting. Of course, that makes the overall economic downturn worse than it otherwise would be, because now we have a contraction of bank lending supply at the same time. Banks may even be forced to suspend convertibility. Some banks may fail if they can't get ahead of this process to restore confidence of depositors in their ultimate risk management and solvency. There are lots of really interesting points that come out of this. Note that there's very limited risk sharing in this story because of the contracting structure of banks, because they're issuing so much debt, that's short-term debt with the first-come, first-serve rule, and that banks are aggravating problems through their contractions of lending supply, that they're creating credit crunches that magnify recessions, and you might even imagine, and of course The theoretical literature has told us, well, it can explain a lot of things that we might want to do as public policies to mitigate this deposit discipline, or to somehow, even if we don't mitigate the deposit discipline, to assist banks, recapitalizations and other things. So the theoretical literature sort of identifies all of those issues. And it also points out that we can have really 3 different kinds of banking crises. And that's useful too, because we do observe 3 different kinds. Within the definition that I've already given you, there are 3 different kinds. Let's just take US history. Sometimes we get normal business cycle shocks. These are the 6 so-called national banking era crises. 1873, 1884, 1890, 1893, 1896, 1907. In the worst of those, from the standpoint of bank failures, which is 1893, total negative net worth of failed banks relative to GDP was 0.1%. Think about that. That's trivially small compared to what we're living through now with more than 100 worldwide crises with a 16% average severity. So those were not crises where lots of banks were insolvent, but rather they were crises where people were worried that there might be an insolvency, and it had to do with business cycle turning points, lots of liabilities of failed businesses. There were very good reasons to be concerned about insolvency risk, even though that increase in risk was small. In other words, as I tell my MBAs when they look puzzled at this point in my lecture, I say, well, suppose I told you that there's a 1/30th chance that your bank is going to fail today, and that if it does fail, you're going to have a 10% loss as a depositor. By the way, that's fairly indicative of these events. Would you take your lunch break to go withdraw your deposits from the bank? And most people would say yes. The expectation of loss, however, is 0.3 percentage point. So it doesn't take much loss in an intolerant market like the deposit market for people to withdraw. Now there's another kind of shock, that's the Great Depression. It also has this feeling of lots of information about aggregate shocks, but the shocks are bigger, and here we do have a lot more negative net worth of failed banks, 2.5% relative to GDP. Note that by modern standards, the Great Depression is a walk in the park compared to what we've been living with on average throughout the world for the past 40 years. And then there's another kind of phenomenon where there's no real confusion about the shock. This is the US in the 1920s, where we see big shocks, but we know that they're related to particular agricultural price declines. So we know which areas, which specialize in those agricultural prices, have troubled banks, and we don't get a general confusion or a general withdrawal of funds from the system. That's the story in the 1920s. So our theoretical models that combine the sort of opacity and the first-come, first-served rule and the lack of risk sharing in the deposit contracting equilibrium allow us to understand all 3 of these kinds of events. Sounds like a pretty good model. However, as I've already pointed out, it's incomplete because it doesn't help us understand why it is that, for example, a country like Canada has none of these events, despite the fact that it's more volatile than the US, while a country like the US has 17. So if we're going to be able to understand this, we're going to have to learn to think historically, to identify what it is about certain moments that tend to produce banking crises. And we're going to then use history in 4 ways. We've already talked about one, which is noting the model's incompleteness, just by some basic familiarity with facts. Also, we want to verify some modeling assumptions. So I'm going to talk about how the discipline market for bank deposits works. The only way I can do that is to show you across various regimes, when discipline exists or doesn't, how things operate differently. That is requiring historical knowledge. Third, we're going to look at history to identify, using sort of narrative understanding of what's going on in certain moments, what it is that causes banking crises, what precipitates them in addition to the contracting structure. And finally, we want to explain, not just identify, that is, why would a country like the United States, as I'm going to show you, tolerate knowingly, consciously, intentionally banking instability so that it produces 17 banking crises, when just across the border, people are laughing at the United States and saying, why won't you fix your problem? And the US when it does analyze the problem, finally, institutionally in 1910, completely agrees with that diagnosis and yet does nothing, almost nothing about it. So that means explanation is going to be very tricky. No economic theory I know, no purely economic theory, is going to be able to explain why countries choose or tolerate horribly unstable banking systems unnecessarily. So that's why I think if we're going to understand what's going on, we're going to have to use historical thinking. So let's talk about verifying assumptions. I have already told you the story from the ahistorical model that says that before we have deposit insurance, deposit discipline drives the equilibrium of banking, the observable shock leading to depositors requesting money back, leading to contractions of lending. So I need to talk a little bit about how that discipline environment works. And this is coming from two papers of mine, one that was published in 2004 in the Journal of Business, and another one that's now forthcoming in the Journal of Financial Economics. And what I want to emphasize, and I don't want to spend a lot of time on this because I recognize that we don't have an unlimited amount of time today. What I want to emphasize is that there's more than one mechanism at work here in how the equilibrium works. I've been puzzled for 30 years about why anyone would give a banker money and walk away. Think about it. Why would you want to be a minority shareholder in a bank where you're not observing or controlling the use of your funds? Or why would you want to be a depositor in a bank? And the answer is, well, I've already given you part of the answer. Demandable debt gives you some protection and creates credible monitoring of the bank because it rewards people who do monitor the bank with that first come, first serve rule. But there's a lot more to it. Banks also publish their accounts in newspapers, and they were audited by government examiners, who, by the way, were hired from a pretty good pool of people to do a pretty good job. And the bankers supported the high quality of those examiners because they wanted to build confidence in the system. Another part of the equilibrium is that if they wanted to attract minority shareholders to the bank, they had to do one of two things. They either had to maintain themselves a very high fraction of the ownership of the bank, skin in the game, at a very high fraction, to show the minority depositors that they were invested personally in an equal position with those minority shareholders. Or alternatively, if they wanted to increase the scale of the bank so that they didn't just have themselves a huge stock ownership interest, then they had to use formal corporate governance techniques, outside board directors, loan review committee, bonding. I'll show you what those are very briefly, to give outside shareholders a voice in the actual and an ability to observe risk management directly. And so what I'm going to tell you more or less is that's how banks did it, through that combination of things that I have here on the slide. I'm going to skip through this, except just to point to this and say, this is that first study that I mentioned, and P just means the actuarially fair default risk premium on a deposit in basis points. So 33.5 means 1/3 of a percentage point spread in terms of default risk. So what you can see is banks were targeting, by the Black-Scholes model computations, about 1 basis point, 1/100th of a percentage point, actuarially fair default risk premium. During the biggest shocks of the Great Depression, they were getting buffeted by shocks repeatedly, and they kept adjusting what was their main tool of adjustment to get that back to 1 basis point. Their main tool of adjustment was contracting their lending, so that in 1929 at the peak, these New York City banks had 75% of their assets in loans. By the end of this period, they had 25% of their assets in loans, 75% in cash assets. So it went from 25% cash, 75% loans, to 75% cash, 25% loans. That's how you keep depositors. You show them that despite the risks that are all around them, that you're maintaining reactions that are creating confidence. Here are some of the corporate governance tools that you use to attract minority shareholders. And what I found in this study is that there's sort of two ways to skin the cat. If you're a closely held bank, you don't have to use those techniques. But if you want to grow based on your own limited personal financial resources, you're going to have to use those voluntarily, those corporate governance techniques. So what we show is that banks do these as well as maintaining adequate equity ratios and adequate cash ratios, and also relying on examiners. So in other words, we can understand banking as a rational equilibrium that makes all of the claimants on banks feel empowered and comfortable prior to the creation of safety nets. I'm going to skip through this. Interestingly, what we find is that if you're a bank that relies on managerial ownership to solve your problems as opposed to a high corporate governance score, you tend to actually be less risky in terms of your depositors. And the reason for that, of course, is that if you're putting all your money into the bank, you're risk averse. And so your risk aversion is going to be driving even greater risk aversion than outsiders of a diversified bank portfolio. The other thing we find is that the use of net worth rather than cash as a risk reduction tool, those are two different ways to reduce the risk of default on your deposits. We find that when the bank is controlled by the managers without a lot of formal corporate governance, they tend to use cash more. Why? Because cash was something that they could credibly signal very easily, because the examiners are monitoring that cash. It's held in other banks, examined by the national bank examiners. There are some other pieces to that story, but I don't want to get distracted. So my point is, we have a pretty good sense of how banks act prior to safety net creation, and I've just described it to you. So that even though we have this very complicated informational production process that banks are doing in their lending, we have a lot of interesting institutions that are being created. The deposit contract, formal corporate governance, examination, publishing in newspapers, that's basically all part of that contracting structure, as well as the bank's decisions about how much cash to hold relative to assets and how much net worth to maintain relative to deposits. Now, when we look through history then to try to find things that precipitated crises, because as I've told you, we can't just say the contracting structure causes it whenever there's a bad shock, because we know that isn't true. It wasn't true in Canada, for example. So I want to point to three kinds of things that come out of this historical discussion. One of them is what I'm going to call political shocks. And by that I mean wars or expropriations. And I'm going to talk about a couple of examples, or regulatory shocks, regulatory actions, which you could think of as expropriations, but not necessarily, depending on what kind of regulatory action. Secondly, and this is especially relevant for the United States, purposely choosing a very unstable industrial organization structure. In the U.S., we called that unit banking, which meant that banks, for most of U.S. history, could only maintain one office. It wasn't until 1997 that the United States removed all limits on nationwide branch banking. And until 1980, the rule was, not the exception, the rule was that almost all banks in the United States operated one office. So this is not just some distant historical fact. This is something that was a major constraint. Now, it caused huge problems, as we're going to see. I'll just remind you, obviously, diversification problems. If you're in one location where they only grow soybeans, your bank is hugely exposed to soybean risk. Furthermore, the coordination problems are immense. Imagine 30,000 banks, all located separate from each other on a map of the United States, trying to coordinate a response to a financial crisis, to a recession that's making depositors nervous. Now imagine instead 20 banks that operate all over the nation, coordinating their response to a similar kind of shock. Guess what? The 20 can do it. The 30,000 that are located separate from each other can't. So it's both a diversification story, but it's also a coordination and response to crisis story. The third category of shocks is safety nets themselves. As I'll show you, there's nothing more agreed upon in the financial economics literature right now than that the major reason we're in the middle of this global pandemic that we've never seen before, of severe and frequent banking crises, are the safety nets that we've erected themselves. And now, when we come to this, of course, it's going to be interesting to ask, are these going to, when we try to figure out where these shocks are coming from, are we going to be telling stories that have to do with an economic equilibrium? Well, in some very, meta sense, yes, because everything's about bargaining in economics, politics included. But you get my drift, that these are stories that are going to have to do with political equilibria and with understanding what makes some countries have a particular political equilibrium, not just stories about the contracting structure of banks in some ahistorical sense. Let's go through a few of these. Well, I couldn't resist talking about the first banking crisis that we know anything about because it happened in this country. It happened in the year 33 AD, and it swept the whole ancient world. What caused it, we know from Tacitus. By the way, this is a great example of a hoax. So there was a professor of history at the University of Minnesota who thought he'd have a joke and wrote a monograph about this crisis where he pretended to know the names of all the players in Rome and basically just created a mirror of the Panic of 1907. He wrote this in 1910 as a joke. And unfortunately, if you go on the web right now and look for Panic of AD 33, you'll read all these very detailed, completely false accounts that are all traceable to his 1910 book. The only real source we have for this is Tacitus. And Tacitus explains to us exactly what happened. What happened was that a bunch of debtors, borrowers, lobbied the Roman Senate and said, we've got these usury laws on the books, but they haven't been enforced. And we'd like to see them enforced. And to make a long story short, because almost every Roman senator was guilty of having charged, in the process of charging on a regular basis, interest rates above the usury ceiling, they decided to give themselves 18 months to liquidate all of their non-compliant loans. Guess what happened? Huge credit crunch. Furthermore, to try to ease the effect of this on land, which was falling in value as a result of this credit crunch, they said, well, why don't we do something else? We'll put a restriction that says that loans have to be, a large percentage of loans have to be collateralized by Italian land. Well, that's another restriction on the supply of lending that made the supply of lending contract even more. So what happened, as you can see from this graph, is we went from this point above the usury ceiling to this point over here, where there are two shifts, one imposing the usury ceiling, the other imposing the new collateralization law. And of course, we got a lot of problems because asset values started plummeting, especially land values. What happened? Emperor Tiberius intervened to provide the first lender of last resort assistance to banks in the form of a 3-year zero-interest loan to the Roman banks, and the crisis immediately ended. So that is obviously a story about a particular regulatory or political shock that we can understand as a politically motivated exercise by debtors. That theme, that debtors or would-be debtors are at the heart of the politics that drives banking crises, is a theme that you should take to heart. How about the first bailout? So I just told you about a crisis and a bailout. The first crisis we know much about, and was also the first bailout we know much about. How about the first U.S. bailout of banks? Well, this was in 1861, and it's not often understood as a bailout, but it definitely was. What happened was the North was fighting the Civil War, just had started fighting the Civil War, and stuffed the banks full of debt in the hope that, by the way, the interest rate charged on the debt would be lower, because would the government want to cause bankruptcy of the whole banking system? No. So that was a credible commitment, we would think, by the government. Would be more credible if the debts were all held by the banks. And that's exactly why they were held by the banks. Except Somebody forgot to tell Salmon Chase, the U.S. Secretary of the Treasury, and right after he stuffed the banks full of debt, he put out a Treasury report that said, the war's not going well, we're going to have to spend a lot more, and I don't really feel like levying any taxes. Government debts go down, the banks are full of them, they have to suspend convertibility. What does the government then do? It says, well, we have to somehow get this back on track, so let's invent a power that the Constitution doesn't say that we have, which is to print fiat money, called legal tender notes, called United States notes. That is how we got the power on a perpetual basis in the United States to create legal tender currency, was because we needed to reduce the nominal value of deposits in gold terms, because the value of the other side of the bank's assets had fallen. So the way to make the bank solvent again was to reduce the value of their deposits. How do you do that? Create an inflation, and then the dollar value of deposits in real terms goes down. That's the first U.S. bank bailout. Okay, what about unit banking? Notice here, if we looked at a random year here in 1904 at the U.S. and Canada, Canada's banks have a cash assets, inclusive of treasuries, to total assets ratio of about 27%, and they have an equity to assets ratio on the other side of the balance sheet of 19%. The U.S. banks have 20% equity to assets, but safer than Canada, right? And 45% cash assets. So by this you'd say the U.S. should be a bastion of great safety, but we know that it wasn't. And the reason was because, as I've already pointed out to you, systemic risk existed in the U.S. because of lack of diversification and lack of ability to coordinate in response to a shock. I will explain what coordination means when I get there to talk about some very useful, interesting safety nets that were created in the late 19th and early 20th century by these banks that weren't like the U.S., that weren't unit banks. So the U.S. should have been safer by that, but of course what we're really seeing is that the U.S. banks are holding more equity and are holding much more cash precisely because they're less diversified and because they can't coordinate as well in response to a shock. Finally, after these shocks occur, and by the way, we can predict every single one of these shocks from the national banking era, if we know a combination of two facts: liabilities of failed businesses that the banks, of course, are lending to, if those increase within any quarter by 50%, and if the stock market falls by 8% or more, we get a banking crisis. This is a perfect fit. This predicts every banking crisis that happened during this period, makes no false predictions. So clearly, these banking crises were produced by observable shocks with unknown incidents that were creating general withdrawals from the banking system. But of course, as I said, that was only because of unit banking. In other countries, these shocks didn't produce that. Why? Banks were better diversified, so there wasn't as much concern about their risk, and, as we'll see, they could also coordinate. Now, the U.S. decides we're just so embarrassed after 1907 that by 1910 we convene the National Monetary Commission. And the National Monetary Commission is charged with figuring out why the U.S. is such a bastion of instability. Now, if you've ever seen these volumes, they take up a very large shelf. There are 3 volumes about Canada, 3 about Germany, 3 about the UK, 1 about Belgium, 1 about Mexico, 1 about Italy. I think there may be 2 about France. You get the idea. And what do they conclude? Of course they conclude unit banking is the problem. But they don't propose to fix that. Why? Because it's not on the political menu. Instead, they propose to do something that's sort of a palliative, which is the creation of the Federal Reserve, which is intended to reduce seasonality risk in the loan market, which I'll explain in just a minute. Did this bring to an end U.S. bank instability? Well, of course not. I already told you we had the shocks in the 1920s in the agricultural areas, massive numbers of banks failing, and we had the Great Depression. Did the architects of the National Monetary Commission know that this would not bring it to an end? Of course. But they did something they thought was constructive, which is to make liquidity risk a little bit less, to make the national banking era panics go away. That is, and I think that they were fairly successful in that. They didn't make the other kinds of panics where there's severe solvency shocks go away. I'll explain a little bit about the evidence that we have about the Fed and what the founding of the Fed did. But it's very important to realize the National Monetary Commission wasn't stupid. They knew that if we had just adopted the Canadian system, that we would have avoided all of the banking crises, but we didn't. This is what the Fed does. It's a flattening of the loan supply function. And the way that it does this is during periods of peak loan demand, it allows you to sell some of your loans to the Fed so that your own leverage doesn't go up by as much and so that your own ratio of loans to cash assets doesn't go up by as much. And what that does is it means that the loan supply function flattens. What should that mean? It means that at seasonal frequency, we should see less seasonal up and down in interest rates and less seasonality in the loan to cash assets ratio. So I'm not going to go through these graphs. That's exactly what they show. And that seasonality should be picked up by the Fed's balance sheet, which is exactly what happens. This is a new study that I participated in. It's a working paper. What we show is also that the banks that had the option not to join the Fed, state-chartered banks, of those, the ones that were most likely to join the Fed early were those that had a lot of seasonality in their lending, and that joining the Fed allowed them to increase their average loan-to-asset ratio. In other words, the Fed as a mechanism made sense. I'll skip that. But as I've already said, it didn't stop the bank failures in the 1920s in ag areas, and it didn't stop the bank failures in the 1930s either. Again, because those banks were fundamentally insolvent because they were unit banks, and they weren't able to coordinate in response to their problems, again, because they were unit banks. The U.S. also, as part of an attempt to mitigate this problem, didn't just invent the Fed, but in the middle of the Great Depression invented something else called preferred stock injections into troubled banks through something called the Reconstruction Finance Corporation. This was a fairly effective mechanism that I've written about quite a bit. But my main point here is this mechanism, again, was putting a Band-Aid on, I won't say a gunshot wound, but something fairly severe. So what we're doing in U.S. history is, because we can't deal with the core problem, we're putting other things on top of it. By the way, why did anybody want unit banking? And we know the answer to that. It's pretty simple. If you were a landowning farmer, you wanted to tie the banker to your local business. Why? Because if your land values went down, a banker that was a branch banker might decide that this isn't such a good time to renew the loans against soy land or corn land. So by having the banker only located in one place, you removed a lot of options for the bank. Now you might say, well, wait a minute. What if the price of soy and corn fall a lot and the bank goes bust? Well, if you're a soy and corn farmer, you're going bust too. So you're paying higher interest rate on your loans. The bank isn't as well diversified. Why? Because the bank's going to charge you this implied credit risk insurance. So you're getting credit in sort of bad states of the world that you might not otherwise get, and you're tying the bank to the area to do that. And that explains why this was, we have a lot of empirical work on the politics of this explaining that. In other words, agricultural landowners were the ones who called the tune in a political coalition, debtors again, calling the tune about the politics of what bank structure is going to be, to great effect on the negative side of the history of U.S. bank instability. I'll skip through that. What about safety nets? 6 U.S. states passed, prior to the Civil War, safety net deposit insurance schemes. 3 of them were designed horribly. They had limited assessments, free entry, and government enforcement of the rules. That combination of things has been analyzed by me and by others, and we've shown that as an economic theory, that's going to be a disaster, and indeed it was. And then after World War I, 8 other systems that were designed exactly with this same formula all collapsed in the 19-teens or 1920s. And it was that collapse of these deposit insurance systems that led Franklin Roosevelt to oppose them. So when he's running for president in 1932, he says, deposit insurance would lead to laxity in bank management and carelessness on the part of both banker and depositor. Notice his understanding of deposit discipline. I believe that it would be an impossible drain on the federal treasury. Also noticing that eventually the bill would come home to roost with the taxpayers. But there's a political story about why he acquiesced. And that's a long story, but I'm going to tell you it comes down to the same thing. Unit bankers insisted if they were going to support what he wanted, that he had to support this. And so again, rather than getting rid of unit banking, which we were right at the cusp of doing, we went in the other direction. We preserved unit banking with yet another palliative. In the study of what's going on when these states are passing these deposit insurance systems, what we see is it causes enormous growth in these agricultural areas because it's subsidizing risk, and it's also causing enormous collapse. And so we see that in the 3 states that had long-lived compulsory deposit insurance systems, that they had massively more costly failures than the other states. Again, I'm skipping the details in the interest of time. Branch banking, in contrast, stabilized systems that were under stress enormously. We had a few states, just a handful in the US, that had branch banking, so we can do that comparison. Similarly, there's been a lot of study, as I've already mentioned, of the current pandemic that we're living through that has put the bill for this risk squarely on the shoulders of government decisions to expand safety nets. I won't review that literature, but it's a massive literature. I'll skip through that. I do want to mention this, though. Prior to this period, we had developed a very interesting system of safety nets that worked very effectively, especially when they worked in concert with a nationwide branch banking system. So the Banque de France in 1884 engineers a very interesting safety net intervention. The Barings crisis of 1890 is almost identical to it. So what they do here is the banks come to the Banque de France or to the Bank of England, and they say, we're worried about an information externality, a systemic risk problem. They don't use these words, but those are what they're saying. We're worried because somebody's in trouble, and it may be that people will start questioning the clearing banks in London, the commercial banks. So Barings is in trouble, but people may not understand that we're not really exposed to that risk, and it may lead to a run on the banks. So what we want to do is we want you, the Bank of England, to bail out Barings. And the Bank of England says, you first. The Bank of England says, you create a fund where you each contribute to take the first tranches of loss, and we'll back you up. And that works like a charm. What a great mechanism. By the way, in Mexico in 1908, we invent securitization. I didn't invent it, I should say. Jose Limantour, the finance minister, invents it to do precisely that. He tells the banks, yes, you're in a liquidity crisis because of what's going on in the US. Pool some of your loans into one group. You retain the junior tranche. We, the government, will take the middle tranche, and we'll sell the super senior tranche in the global market. I could talk for a long time about why that's such a good idea, but notice that it had the same feature of having the government help, but in a way that had the banks bearing the risks collectively, first losses of the loan pooling. Canada's banks, what they did was even more interesting, I think. When a bank fails in Canada that they don't judge is of systemic risk, in other words, doesn't create this negative externality of concern for the other banks, they just let it fail. But on 2 occasions, they believed that it might create this systemic risk. So what did they do? The Bank of Montreal acquired the bank that was failing, and then they shared the cost of the bailout on a pro rata basis with all of the Canadian banks. In other words, safety nets used to be things that the banks themselves paid for. Isn't that interesting? And they worked pretty well. Now why, and I'm coming to the end here, I'm going to cut this short too, so The final thing about thinking historically is it allows us to think about why these things are happening, not just what are these things that are left out of the contracting theories of crises. What is this incompleteness? Where are these? How do we identify these things? But it also allows us to understand, and of course the answer is going to be all about political bargaining. You'll have to read my book with Steve Haber to get the full flavor of that. But the point is, there's something about the Canadian constitutional system that's different from the US. And there are good historical reasons for that. And those differences translate into, in Canada, the banking system is not a political football where a coalition of would-be debtors can get together with a certain set of bankers and turn the banking system to their interests, whereas that happens all the time in the US. And most recently, it happened in the US, when we finally got rid of the unit banking system for all of these reasons. I'll skip through it. But what happened now, when we got rid of it, banks still had to apply to the Federal Reserve, which is a deeply politicized institution, to get approval of their desire to become massive, nationwide, too-big-to-fail banks. And to get that approval, they had to get political permission. And the political permission comes from the testimony of community activist groups. Those community activist groups come to the hearings and testify. How much did the banks pay the community activist groups, and what did they pay them with? Well, they paid them from 1992 to 2007 with $2.4 trillion worth of cash and loans. And those loans were very risky mortgages. And the government realized that that would only have happened if they had also created another set of mandates called the Gse Mandates that required Fannie and Freddie to buy a lot of those mortgages so that the banks were willing to pledge even more because they knew they weren't going to stay on their balance sheets. In other words, the story of the mortgage crisis is none of the things that you all are probably thinking. It's a political story about debtors and banks in a coalition. The would-be too-big-to-fail banks and the would-be subsidized urban debtors now, switching from the rural debtors controlling the game to the urban debtors. In the interest of having a few minutes for questions, I'm going to stop there. But I do want to point out a couple of things. Notice real estate is often the trouble. And of course, it's because it's an illiquid asset. It tends to track the business cycle, so it's non-diversifiable. But it's also, what is politics? Local. And what is real estate? Local, by definition. Finally, let's conclude with some persistent themes. I mentioned this for the U.S. Civil War. It also holds, of course, for the chartering of the Bank of England and many other things. Government financing needs lead to expropriations or various kinds of war financing gizmos that tend to have been very destabilizing of the banking system. Real estate borrowers, I gave the examples of rural borrowers and then later urban borrowers in the U.S. But I could have talked about Argentina in 1890, Australia in 1893, Norway in 1900, Italy, by the way, in 1893, as all examples of other real estate-related crises that had to do with debtors and their politics. Of course, since the 1970s, the main problem has been the spread of safety nets, and I think it's important to recognize that regulation and the failure of regulation, purposeful failure of it, the inadequacies of it, along with crises and bailouts and safety nets, are all part of one single political equilibrium that's all very closely related. And my final conclusion, these outcomes differ across countries and across periods because politics differs across countries and across periods. And if we're going to confront this, we have to confront it as a political problem, not as a problem about bank contracting structures per se. Yes, bank contracting structures have the potential for instability, but only the potential, only in combination with purposeful bad political choices that we're all living with to great cost. Thank you for your attention, and let's have some questions.
Well, thank you, Professor Calomiris. I read parts of your book, and I have a comment and a question I'd like to ask. My comment is you seem to put a lot of emphasis on the unit banking system, and I certainly think that was a contributing factor. But I'm not sure that really was the primary factor causing many bank failures or crises in the American banking system over the last 200-300 years. So that's just my comment. So I mean, you and I can debate, but not today. My question is, if you look at the so-called Lehman banking crisis of 2007, and look at the U.S. and Canadian banking systems, as you correctly pointed out, we had a lot of troubles here in the U.S., but not in Canada. And by then, obviously, the unit banking system was gone in the U.S., so that does not explain why the Canadian system was much more stable. Now, if you were to ask Canadian banks the same question, I'm just quoting, what I've heard from Canadian banks, they would say, we just have a better regulation had a better regulation than you did. So I guess that is my question. Why didn't the Canadian banks, do poorly during the financial crisis? Because at that time, we did not have the unit banking system in the U.S.
Let me just focus on that. I mean, I will say, you're alone in your statement about unit banking not having contributed for the prior 200 years. I mean, I don't think there's anybody who has made the, I'm not out on a limb on this argument about unit banking and bank instability. That's basically the whole literature. But let me talk about Canada. And I completely agree with your question. I really like your question because the point is, regulation is itself an outcome, right? What is it an outcome of? Politics. So yes, Canadian bank regulation has been excellent. But why? Why? And it's not just a story about the last crisis. I mean, Mark Carney got a great job with a great salary by taking a lot of credit for being the Canadian banker in the last crisis. But he wouldn't have gotten such a good salary if people had noticed that for the last 200 years they've never had a crisis. And he wasn't around for most of that period. So what is it that makes Canadian, so we could peel back the onion one layer and say, what is the regulatory system of Canada that's so special? There are lots of interesting features to it, by the way. For example, every 5 years, bank charters expire and the banking law in Canada expires. They have to make a new law every 5 years. It's a very interesting phenomenon, and the whole structure of it's very good. But I would also point out to you that that's just one piece. Another piece, which has, of course, been the main thing, is their branch banking system, which has existed since the first charter in 1817. But then you could say, well, why did they choose a branch banking system? By the way, that wasn't a foregone conclusion. And in the 19th century, people tried to get them to convert to a unit banking system. And the Secretary of the Treasury in Canada was even bought into this political deal. And the lower house in Canada seemed like it was interested too. But this all ran aground in the Canadian Senate, along with all the other bad ideas about banking and imitating the U.S. structure. They all ran aground in the Canadian Senate. The Canadian Senate, anybody know who elects Canadian senators?
Nobody does.
Thank you. It's a trick question. Nobody elects them. Now, the key answer, though, just to come back to it and so we can move on quickly, the key answer is the Canadian Constitution is completely different from the U.S. Constitution. It centralizes power over the banking system in the central government, and it has a Senate that's not elected. And this has been the main reasons, and we can identify it, we do in our book very carefully, that the Canadian political system doesn't allow the banking system to be a political football the way it is in the U.S. And then endogenously you get good regulation, because that's the equilibrium once you take it out of the political process. And now then the question would be, why did they pick that constitution? And the answer is because they had to deal with Canadian geography and the French. And the combination of those two things as initial conditions to British settlement of Canada meant that they had to find a way to prevent the French from impeding, French Canadians, from impeding all the developmental progress in Canada while keeping Canada a democracy. And that's what they did in 1841 and again in 1867. It's a long answer to a very good question.
As a Canadian, we also had to finance and build the Canadian Pacific Railway to Vancouver.
Yeah, but these decisions were made when you were thinking about canals, because the French were blocking the building of the canals. And remember, other than the Lachine Rapids and the St. Lawrence Seaway, you're sort of stuck. And so Quebec was very much playing that game course, you had a mini revolution in 1837 where the French Canadians were trying to get independence. And then in 1840, Lord Gosford basically figures out we need to go in a direction of centralization to dilute French influence in Canada. And that was, by the way, there's another country where the story is very similar, where the role of the French is played by the Maori in New Zealand. Very similar kind of constitutional outcome.
Anna Schuster, New York. I was wondering, well, first of all, I have to admit I have not read your book, so I was wondering if, and whether you incorporated Hyman Minsky idea of the financial fragility that has increased over time, because if anyone addressed the issue of the financial fragility historically, that probably would be him. And his idea is based on the change in dynamics over the time between the financial sector and the real sector. And so the argument would be that probably there were more banking crises at the end of the 20th century simply because there is much more relationship between the financial sector and the real sector, and so sort of much more capitalist finance.
Well, I don't agree with you. So I knew Hy Minsky pretty well, and I read his 1975 book several times, cover to cover, and we criticized him in our book, and I don't think Hy was a historian. I don't think he would claim to have been a historian at all. He was a theorist. Charles Kindleberger was the historian, but he was pretty superficial in his discussion of banking crises and all of these issues. So we think, I would say, speaking for myself, that I think their model is this behaviorist sort of greed and fear oscillation model is wrong as a theory of banking crises. So I think we take it on in chapter 15 directly, and I don't think that doesn't mean that there isn't fear and greed, but it's just, it's not going to explain the heterogeneity. Now, you could say, so in other words, any model that's going to explain the heterogeneity is going to have to explain regulatory differences, and those always have political foundations. So that's my take. I'm pretty aggressive about it, as you can see.
There's one question here behind, but then we have to stop.
Thank you, Philip Booth. There are a lot of similarities, obviously, between Britain and Canada. Both had very concentrated banking systems, which, as you said, made coordinating responses to crises much easier, and that happened several times. In the UK, I don't know about Canada, but the UK had until 1946, privately capitalized central bank which could prudently decide when to intervene. Both were very late comers to deposit insurance, the UK a bit later than Canada. So I'm just wondering what the difference really is.
Well, there's a big difference.
When we reach the crisis point, when two UK banks failed.
Our book goes through 5 countries in detail. The UK is one of them. UK, the US, Canada, Mexico, and Brazil, which I didn't talk about at all. They're quite different autocracies, basically. The story in the UK is that there were really 4 different periods of sort of the equilibrium, the political equilibrium of banking. The sort of heyday is starting in the late 1840s, going up till World War I, which is this period of branch banking consolidation and efficiency, where the British banking system looks a lot like Canada. Before that, it's Scotland that's sort of an outlier within Britain that's behaving in very innovative and very stable and interesting ways. And that's an interesting political story too, because it's all about political disarmament of the Union Act of 1707. There's a lot of really interesting stories there. And then, as you correctly pointed out, after World War II, because you got changes like the nationalization of industry. Now, they didn't nationalize the banks, other than the Bank of England. But with the nationalization of industry and various other liquidity regulations on the UK banks, they sort of became a sideshow. Not much going on in UK banking. It really wasn't until the 80s when banks in the UK became global powerhouses as part of a conscious political decision by Margaret Thatcher. So what's interesting is I think a lot of people would sitting in this room say, oh, the UK must have always been a global leader in banking. Not so.
It would be very interesting to continue this discussion, but unfortunately, 5 minutes from now, the next sessions will start. So